Hello friends, this is Vijay Bhambwani here, and in this video I'm back again with you to discuss what happened in the markets last week and what we can make out of the markets in the coming week. So our markets basically weathered the Evergrande storm rather well. And even though we did have declines in our markets, in relative comparison with the overseas markets, the Indian markets seem to have held their own. Then came the fuel crisis, where spiraling natural gas prices with shortages across Europe and Asia sent shockwaves of nervousness. Here again, we happen to have held our own relatively well. In the fag end of this video, I have recorded a special segment as to what is likely to be the reason why the Indian markets are exhibiting such extreme relative strength and what we can expect going forward. So please don't go away. Stick with me in this video till the end. Let's dive right in and see the market roundup window that is on your screen, which very clearly tells me that the Nifty underperformed the Bank Nifty because it fell relatively more than the Bank Nifty. Bullion rose because of safe haven buying. Oil and natural gas flared up. Like I said last week, we saw energy crisis, and that basically triggered inflationary fears worldwide. Now, the Dixie, which is the US dollar index, rose, which added to the pressure on global equity markets because the rising US dollar is a sign of weakness for emerging markets, including India. The Indian rupee also weakened against the dollar, just as the Dixie says the dollar rose against the global basket, but it fell against the dollar relatively less than the Dixie rose, which means it basically was a relative outperformer as compared to many of its global peers. We'll discuss this reason at the fag end of this video, like I told you in the special segment. Now, the 10-year benchmark bond yield rose to 6.24%, which is the upper end of the quarterly range due to inflationary concerns. Now, coming up on your screen is the MWPL, or the Market Wide Position Limits chart, which shows a routine fall on expiry. This is the market-wide open interest, and this fell on expiry day, which is routine, but the fall has been somewhat smaller than the historical average. Now, this seems to point towards hope-based buying by traders. Now, on your screen is the basis chart. Now, the basis is nothing but the premium enjoyed by the futures as compared to the spot. Here, the Nifty shows inversion, which means that the future is actually trading at a discount to cash because selling and hedging both is the basis on the Nifty 50. The Bank Nifty in relative comparison saw a positive basis because short covering at lower levels cushioned the declines. Now let's see the index and the stock futures volumes chart. Now, this chart shows that the turnover, and remember this is cumulative turnover of October, November and December futures. Now, the cumulative turnover fell rather sharply. While this was expected because whenever markets turn nervous, traders do seem to pull back from enhancing their exposure. But we still need to watch the turnover and the open interest carefully in the coming days. Now, the impetus, which is our exclusive in-house study, you won't see anywhere else in the free domain, which has been a rather solid indicator of which way the markets are going. We saw the volatility or impetus expectedly slow down on a week-on-week basis because the markets saw the upward momentum easing and then reversing. Ideally, I would want the prices to rise along with the impetus heading higher in tandem. That would be the ideal bullish scenario, but we'll have to wait and see how that unfolds in the market in the coming days. So do connect with me on social media, because I update this data on a day-to-day basis every day, late evening, and my contact coordinates will come at the fag end of this video. Friends, those details done now. Let's now go to see the footprint of the various types of investors in the markets. Let's first take a look at the FIIs, who basically pruned or eased their exposure on the index futures, which are now at 26,831 lots, which was earlier 32,206 lots. Now for their stock futures exposure, which has fallen sharply. Last week it was 2,78,817 lots, and this week it was at 1,25,236 lots. DIIs, the domestic investment institutions, have basically reduced their index shorts to 77,977 lots, which was last week a short position of 89,879 lots. Their stock futures short positions have actually gone up to 13 lakhs and 151 lots, which was last week 12,62,206 lots. Let's now take a look at the proprietary traders, the prop traders, whose index futures are now in the net negative, which is the net short of 9,160 lots, which was earlier 3,128 lots long. Their stock futures net long positions have actually increased to 1,89,380 lots, which was last week at 1,08,069 lots. Now, friends, this is rather interesting for the simple reason that the prop traders are very sharp traders. They are brokers whose own proprietary positions are being measured here. They seem to be, in spite of the expiry of the September series and the commencement of the October series, they seem to have ramped up their long positions. They don't expect big trouble up ahead. But early days yet. Let's see some more data. Now let's go to the retail traders whose index long positions have basically gone higher to 60,306 lots, which was last week 54,545 lots. Their stock futures are net long 9,85,535 lots, which was earlier 8,75,320 lots. Now here the retail traders have yanked up their net long positions in the individual stock futures to period highs, exactly how the prop traders have jacked up their individual stock futures longs to period highs. Now these two traders, which is the prop traders and the retail guys, don't seem to be unduly perturbed about the markets. That's a positive sign. Friends, let's now go to the 10-year benchmark bond yields on the bond markets, which basically are one reason why our equity markets have not really fallen. Bear with me as I explain to you. Now, the government announced that it has completed a little over 7 lakh crore mop-up out of the 12 lakh crore collection from the bond market, which the Honorable Finance Minister Nirmala Sitharaman had announced in the budget of 2021. They wanted to collect 12 lakh crores from the bond markets, of which more than 7 lakh crores has already been collected. Now, this cheered the financial markets, which is why they didn't really fall as much as their Asian peers. Now, the 10-year benchmark bond yield has definitely climbed to 6.24%, which is a little below recent highs, but at the upper end of the quarterly range. Now, this market, the bond market, is, I call the big daddy, because it is the source of all finance for other asset classes, does not seem to be showing as much nervousness as many traders feared. Now, we'll discuss more on this at the fag end of this video in the special segment which I told you I've recorded. Now, so far so good. we must keep watching these signals on a day-to-day basis. And going forward, I'm going to keep updating this stuff on my social media accounts. So do connect with me there. Friends, let's now take a look at the US dollar index, the Dixie, which is the currency benchmark. And this index created a storm of fury last week due to the flight of safety that we saw after the Chinese credit crisis and the fuel crisis got triggered. Now, like it or not, the Dixie impacts everything from commodities, treasuries, and even inflation in emerging markets, including India, which happen to be import dependent, and they also happen to have a lot of overseas debt. So the US dollar levels do determine a lot of economic data in our country. Now, the Dixie managed to breach the 93.5 hurdle, which I have been talking about for many weeks, and as you can see on the daily chart. Now, 93.5 was seen last time in April 2021. The price now is way above its 25-day exponential moving average, which means the short-term outlook is positive for now. The weekly chart on your screen shows a big bullish candle which has scaled levels last seen in September 2020. The price remains above its 25-week exponential moving average, which means even the medium-term outlook is positive as well. Last week, I advocated a range between 94.25 on the upside and 92.30 on the downside, which was overcome marginally on the upside because the dollar index really jumped after nervousness in the Chinese and the European energy markets was seen. In the coming week, I expect an estimated, I stress upon the word estimated, range between 95.10 on the upside and 93.10 on the downside. So do watch this space very keenly, and a lot of things will depend on the Dixie. Friends, let's now go to the Bank Nifty, which fell 1.6% on a week-on-week basis. And as you can see on your daily chart on your screen, the index has fallen on 4 out of 5 trading sessions. The markets put up a brave front on Monday, but they slipped thereafter. Now, the Chinese crisis and the fuel price hike in Europe is a primary reason. The closing on Friday on your daily chart on your screen is above the 25-day exponential moving average, but barely so, which means this index must be defended by the bulls if the short-term momentum is to remain intact. Now, switching to the weekly chart, we see a bearish engulfing pattern, which is the last week's bearish candle's body covers the previous bullish candle's body completely. Now, this is a sign of concern, and the bulls must take the index above the weekly high of 38,377 to dispel doubts in the minds of retail buyers. The price remains above its 25-week exponential moving average, whose importance I explained to you last week, and this means that the medium-term outlook also remains positive, but for now. In the week before last, this index was number 4 on the most volatile list, but it slipped one notch to number 5, not because this index's volatility fell, but because individual stock futures volatility rose in relative comparative terms. Last week, I advocated a range between 39,250 on the upside and 36,425 on the downside, which held perfectly well in spite of the volatility. Now, a little bit of a narration about these ranges that we compute. Now, these are computed telescopically, just as you have a telescope which can contract and expand. We basically factor in the rising and falling volatility on a week-on-week basis in the market, which is why in a week where the volatility is extremely high, in the next week the range is wider. In a week where volatility is lower, the next week ranges contract. So these are dynamic bands. The coming week is likely to see an estimated, I stress upon the word estimated here, range between 38,650 on the upside and 35,800 on the downside. Friends, I continue to advocate trading light due to the uncertainty and the falling volumes. I also recommend that you maintain stop losses very diligently on all your trades. Friends, let's now go to the Nifty 50, which fell 1.80% on a week-on-week basis, and relatively it fell more than the Bank Nifty due to the Chinese credit crisis and the European fuel crisis. The index, just like the Bank Nifty did, fell on 4 out of 5 trading sessions. As you can see on the daily chart on your screen, the price stayed somewhat better and higher than its 25-day exponential moving average, whose importance we discussed in the last week's video. As compared to the Bank Nifty, the gap between the price and the moving average is higher in the Nifty 50. Look at the bullish channel indicated by 2 blue trend lines, which is intact so far. The 16,850 levels approximately seems to be like the channel bottom support to watch out for in the coming weeks. I repeat, coming weeks, not the coming week. Coming weeks range will come later, but 16,850 is slightly beyond the coming week itself. That's a level to watch out for. The weekly chart on your screen shows a red bearish candle which is piercing the body of the previous week's bullish candle. Now this shows a breach into bull territory, but the breach is not as severe as the Bank Nifty, where the red candle was completely overpowering the previous green candle. Now, what can really change the scenario is if the bulls take the Nifty past the 17,943 high of last week. On the flip side, if the Nifty is trading below the previous weekly low of 17,452, you may see some more downsides being triggered. In the week before last, this index was number 14 on the most volatile list, but it slipped 5 notches to number 19. Here again, not because the volatility in the Nifty lowered, but individual stock futures volatility actually rose more than the Nifty. Last week, I advocated a range between 18,300 and 17,400, which held perfectly because the low was 17,452, a mere 52 points higher than the weekly low I advocated. Here again, I calculated the intra-week ranges telescopically, adjusting for the statistical beta or the pure price volatility. The coming week is likely to see an estimated, I repeat the word estimated, range between 17,975 on the upside and 17,075 on the downside. I continue to advocate that, my friends, we trade light in view of the uncertainty prevalent in the markets right now. Connect with me on social media, wherein I will be posting more updates on a day-to-day basis. End of the day, my contact coordinates will come at the end of this video. Friends, now the indices done, I come to the most popular segment of our video, wherein I give you 5 stocks where the impetus has jumped on a week-on-week basis, where you can take small exposure, wait for large price moves, and 5 stocks where the impetus has fallen on a week-on-week basis, where you can take bigger exposure, wait for smaller price moves. Why the difference? Because different traders, different mindsets and attitudes and aptitudes, and therefore different techniques. So I start with the 5 stocks that are high beta, high impetus, led by Power Grid at number 1, number 2, HDFC AMC, number 3, Indian Oil Corporation, number 4, Tata Power, and number 5, Hindustan Petroleum or HPCL. Note, almost all these counters, with the exception of HDFC AMC, are in the power sector. The 5 stocks that have fallen in impetus on a week-on-week basis, where you take big exposure and take smaller price moves, the list is led by Ramco Cements at number 1, number 2 Tata Steel, number 3 BPCL, number 4 ITC, and number 5 MGL or Mahanagar Gas Limited. Now, friends, this hierarchy of stocks in the high and low impetus can change on a day-to-day basis as intraday volatility rises and contracts. So do connect with me on social media. I will be updating these pages, these data points every day so that you can update yourself in real time. Friends, now I come to what I promised you as a special segment as to why our markets have been holding resiliently in spite of the negative news floating around, and why, compared to some of our Asian and European peers, the Indian bulls are holding on. There are primarily 4 reasons I can think of. Of course, there will be more ancillary reasons. I'm talking of primary reasons. Number 1 is that in India, COVID cases are not rising as fast as they are rising overseas. Number 2, the CEPA, Comprehensive Economic Partnership Agreement that India is negotiating currently up to December 2021, which is likely to be signed by 31st March 2022, is likely to result in a multiplication of 2.5 times of the trade size that India and UAE have together. Now, this was a big trigger of strength for the INR, because future investments coming into India, both in terms of manufacturing and non-manufacturing investments, which means FPI, FII, FDI, all right, is keeping the markets enthused. Number 3 is listing of the Indian bonds in international indices, which the government of India has announced, which could happen fairly soon, even in this financial year itself. Which means that overseas investment institutions, particularly long-term pension funds and fixed income debt funds, etc., will invest big sums of money in the Indian sovereign bond market. That reduces the strain on the public sector banks to buy these bonds so as to provide working capital for the government of India through the RBI bonds. That is another factor that is cheering our markets. The 4th factor is allowing Indian resident and non-resident Indians and retail investors to invest in the bond market directly through the RBI's platform in the very near future. Now, this again raises the cash flow levels of the government, because you can now directly buy the bonds off the platform without any middlemen's charges, etc., directly from the RBI. Now, these factors are cushioning the declines in the Indian markets, which of course are nervous, and they should be, because the world around us has become a little more uncertain, or a lot more uncertain actually. But in relative comparison, India seems to be doing relatively better. Now, as long as this feel-good factor, or rather these feel-good factors continue, I think we will fall less than the others, and whenever the rally comes, we will probably rise faster than the others. Now, of course, this is the data points that we have up to now. Things, of course, will keep changing, which is why I tell you, do connect with me on social media. Friends, I am at the end of this video. If you really liked what you saw, do subscribe to my YouTube channel. In the comment section, do let me know what you think about this video. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Help me to reach out to fellow like-minded investors and traders who care for data, logic, and rationale in their trading and investment decisions by referring my video to your family and friends. And in the description segment below the video itself, there are hyperlinks to Equity Masters YouTube channel, wherein I put up a couple of videos every week. Do subscribe to my channel there as well. And there is a link to a free trading guide from Equity Master as a free PDF file. Do avail of this offer and empower your trading experience. Friends, I bid goodbye to you. Thank you for your patience and being with me in my video today. Till we meet again in my next video, this is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.